Okay, now we're going to take a look at some of the tools that we're going to use throughout the rest of the semester. The first one, the simplest one we're going to do is something called payback period, right? Very often a bank or an investor wants to know, how long is it going to take me to get my money back? With an investor, that can be a little more complicated because it's based on cash flow, future cash flows, things like that. With a bank, a little bit different. So what we want to do in the payback period calculation here, we want to know the amount of time a project requires to pay back the initial equity investment, or in the case of the bank, the initial or the outlay or the amount of money that you borrow from the bank. So why would we do payback period? Well, one, banks really like to see this. Investors really like to see this as well. And it is very easy to calculate. You'll see simple division, takes a couple of seconds, and you have an answer, okay? But it's not perfect, okay? This doesn't include the time value of money, right? So if you make additional money in the future, right, you're going to take that cash flow. So it ignores that cash flow after the required payback period, and you're going to invest that money and say, what can I do with this money to make money in the future? However, it's still a very, very important measure. So here's a quick example of payback period, okay? So as I said, it's just simple division. In this example we're looking at, we're going to say we have an asset that costs $25,000. Let's say you own your own restaurant. You're running a restaurant, the dish machine and the dish room is a mess. It takes two people to run when it should only take one. It's constantly breaking down, runs slow, so you have to put extra labor in there. You finally had enough, decide, okay, I'm going to go out, I'm going to buy a brand new dish machine and revamp the dish area. So that is going to cost us $25,000, okay? And will provide incremental cash flow of $10,000 per year, okay? That could be, in some cases, additional cash flow, or in the example I just gave you about the dish machine, it could be a savings of payroll. So instead of having to have two people run the dish machine, we only have one. So what is our payback period on this investment? $25,000 is what it cost us to buy the asset, to buy the dish machine. We're going to cut one person in the dish room, so that's going to save us $10,000 per year. So in this scenario, we get back our money. Our payback period is 2.5 years. We just do very simple division, divide the $25,000 investment by the $10,000 savings that we have. Okay? Now, the next step up is something called the net present value. Calculates the difference between an asset's present value and its purchase price, okay? Now, why would we do something like this? Well, the advantages of this, it takes into account all cash flows, and because of that, it takes in and considers the time value of money. What could we do with the future the future cash flow? We can invest it and we could earn additional money. Now, this is a good tool, but it's not perfect. All right, if you're going out and you're going to decide, hey, there's 3 hotels I'm going to go look at. I'm going to buy one of the 3. I'm just not sure which one. The net present value will be able to tell you if each project in and of itself is a good investment based on net present value calculations. But it will not allow you to look at 3 different properties and make a decision about which is the best one to purchase. We're going to need the internal rate of return to do that, which we're going to look at in just a minute. Okay? So now we're going to go ahead and we're going to walk through and look at this net present value calculation again. So we have done this in Chapter 7. We just did it without putting a purchase price, the CF0, in there. All right? So now what we want to do is we want to walk through this net present value calculation. Again, these are small numbers, but we're going to say that we're going to invest $800, and this is the cash flow we're going to get in return. We're going to have a 10% interest rate, and what kind of net present value are we going to get? So let's walk through this together. So hit your CF function. Then hit second clear, clear again. Let's make sure your CF is cleared from previous calculations. So now hit our CF again. Now it wants our CF 0 of negative 800. So type in 800, hit the plus minus key at the bottom next to the equal sign, and hit enter. Then use that scroll down that we did in chapter 7. And now our year 1, it wants to know how much money are we going to generate cash flow wise in year 1. We type in 50 and enter. That gives us a frequency of 1, and that's what we want. We only have 1 year at $50. Cash hit down again. Now it wants to know our year 2. We type in 100, enter, scroll down. Okay, that frequency is 1 again. Scroll down, now we're at CO3. It wants to know in year 3 how much cash are we going to generate. Type in 300, hit enter, scroll down, the frequency's 1 again. Scroll down again, now we're at year 4. Type in 305, hit enter. Scroll down, frequency's 1. Scroll down again, now we're at CO5. Okay, so now it wants to know how much cash in year 5. Type in 320, hit enter. Scroll down one more time, and now we're at CO6. Okay, so again, as we learned in chapter 7, if you're in 5 years, you go to year 6, 10 years, you go to year 11, 20 years, you go to year 21 to do this calculation. All right, so now as it says on the right part of your screen there, hit the compute net present value key, and it wants to know our interest. So do our IY, in this case is 10, so do 10 and hit enter. Scroll down again, and now it should say net present value equals 0. And as you see again at the bottom right hand corner of your screen there, it says compute net present value. So hit the CPT key, and it should give you negative 39.4925. Okay, and a negative net present value means we do not invest. Okay, it doesn't matter how negative it is, right? We don't touch the investment. And if it's positive, 0 or positive, then this calculation is a yes. That means we're not paying more than the asset is going to return to us. Okay, now don't erase your calculators. Leave that information there. Leave your app open. All right. So now we're going to jump ahead to the next one that I mentioned a moment ago, is this internal rate of return. Okay, it's a discount rate that makes the net present value of an investment equal to 0. Okay. So we're going to get rid of that net present value calculation, and this way we're able to compare multiple deals with varying sales prices and cost. So as I mentioned to you a couple minutes ago, if you're looking at 3 projects, and those 3 projects you're making a decision, you can only buy one, which is the best deal, the net present value would tell you individually if each one is a good deal. But now we're going to compare all 3. That's what we want to do with the internal rate of return. Now, there are some disadvantages to this. It's not perfect also, right? But it assumes that you're going to take that cash flow and be able to reinvest it and get that same internal rate of return, which is not always realistic, right? And it does not like when you get negative numbers. Sometimes you buy a business, first couple of years, you'll get negative returns. It doesn't like that. There are adjustments you can make to it, but we're going to stay away from that. So I won't give you any negative cash flows. We may give you some that are 0, but we're not going to do any negative cash flows. So now on this one, we've already done this calculation. If you see on the left side of your screen there, right, we've completed this calculation already. So now we want to know the internal rate of return, not the net present value. So if your app is still open with all your numbers in there, all you need to do now is hit the IRR button, which is below your scroll down, which we've used numerous times. Hit IRR, and then compute, and that will give you 8.4544 as your internal rate of return. Okay, so our standard is going to be 15%. So in this case, that would not be met. Most cases, I will give you a number, right? It probably won't be 15, probably 12 or 13%, somewhere in that range, but you will be given a number, and all you have to do is meet or exceed the given number in order for the internal rate of return to be a good qualifier. All All right, so one other thing said we were going to look at, one other tool was modified internal rate of return. We're not going to do any calculations with this. The only thing I need you to know out of here is one line. The modified internal rate of return is more conservative than the internal rate of return. That's all I need you to know out of that, and we're not going to touch that beyond what we just did in internal rate of return. So, what are some of our factors that impact our investment analysis? So as you see here, there are 4 that are listed. So let's walk through each one of those and just have a very brief discussion about this. So as I said at the beginning part of this lecture, this is actually a lot of common sense, but it is in terminology some of you have never heard, so it makes it a little bit more difficult for you in some cases. Okay? So in this case, the cost of capital, the more financial leverage that is used, the lower the cost of capital. So more debt makes the project cheaper. The lower the cost of capital, the lower the discount rate, right? Makes sense. So the cheaper you can borrow the money, the less you have to discount future cash flows. And the lower the discount rate, the higher the present value and net present value. All right, the next one is this cap rate, right? This is what we use to project based on cash flows, right? What is the selling price or the value of this asset at some point in the future? So the lower the cap rate, that is going to give us a higher sales price. And if we have a higher sales price, it just follows that our present value, net present value, and internal rate of return are also going to be higher. So if we have a higher cap rate, that's going to lower our present value, net present value, and internal rate of return because the sale price is actually going to go down in that calculation. So back earlier, Chapter 7, we talked about the amount and timing of projected cash flow. So when you looked at an annuity due, if you remember, annuity due was more valuable than a standard annuity because we got the money earlier. So this is the same thing, the amount and timing of projected cash flows. The more cash flow projected in the earlier years, the higher the present value, net present value, and internal rate of return. It also reduces the risk because the odds of you not earning that income reduce as you go forward. So that's a very important part of this discussion. The sooner we get our money, the better. So if it's a deal that is what is called backloaded, in other words, the money comes at a later time, that is not as valuable as one that the money comes at the beginning part of the investment. All right, then the final one. Again, very common sense, but very important that we understand this, right? The lower the price we pay for an asset, right, or the less that it costs to build out a project, the higher the net present value and internal rate of return. Makes sense. Think about it. If you're generating the same cash flow, but it costs you less to buy the business, it is a more valuable investment for you. So what we've seen now in Chapter 8 is a bunch of different calculations that we can apply what we learned in Chapter 7 to Chapter 8. Now the homework that goes with this, you're actually going to practice some of these calculations and start to understand, do I get a positive net present value and do I exceed an investor's hurdle rate? And if I do, then these are good, acceptable investment projects.